Hi, good afternoon, everybody. We'll just give 30 seconds or so to get everybody in the webinar, and then we'll get started shortly. Okay, great. I can see that number's still climbing, but it's starting to settle a little, so we'll get started. So thank you, everybody, for taking the time to join the RMBS Task Force session for the Fixed Income Investor Network's Distressed Credit Trading and Asset Performance Update. Really appreciate you joining today's session. We've probably got a very exciting panel for you. Just as a quick reminder, there's a Q&A function at the bottom of your screen, so we do encourage that throughout the session. If you have any questions, to put your questions in there to the panel, and we'll have our panelists answer those as the session goes on. Once the session is finished, this is being recorded, so we will have this on demand on the IMN website if anybody would like to view the session after the fact. So with that being said, I would like to hand over to Eric Kaplan, who is the chair of the RMBS Task Force and leading this discussion. So over to you, Eric.
Great, thanks very much, Adam. Welcome everyone today. Hopefully in the next several months, we'll be able to start getting back to a hybrid or live format. We look forward to that because I think in the last year we've seen, or at least I've seen, how much I actually did enjoy. I always thought that I enjoyed them, but sort of miss all of our in-person convenings. So looking forward to that. And I hope everyone has been well and safe and is starting to line up in the vaccine queue. So I'm Eric Kaplan. I'm currently a senior advisor at the Milken Institute Center for Financial Markets. Transitioned to that role as of the last 3 years. I joined Milken. I was director of the Housing Finance Program during that period of time. As Adam said, I do chair the Fixed Income Investor Network RMBS Task Force. Among other roles, I also serve I'm an independent director on the Kroll Bond Rating Agency Board of Directors, and I also chair the Consumer Financial Protection Bureau Consumer Advisory Board as well. So wear a bunch of different hats in the space, and started as a lawyer over 27 years ago, jumped to the banking side after a few years. And so I've been issuer, investor, underwriter, worn a lot of different hats across the space. Let me quickly turn it over to Kishore and Steve for them to introduce themselves for a moment, and then we'll get to the discussion. Kishore?
Hi. Good afternoon, everyone. I'm Kishore Yalamanchili. I am at New York Asset Management as a portfolio manager. And prior to this, I've been in the structured finance industry for about 23 plus years, out of which most of the time was spent at BlackRock and then a hedge fund and Prudential in various capacities, primarily in structured finance area. At Prudential, I was in a portfolio strategy role. So my main focus has been in RMBS, CMBS, and ABS sectors.
Thanks very much. Yeah, thanks, Kishore. And Steve?
I'm Steve LaPlante. I'm a vice president at Luna Sales in charge of global RMBS and covered bond research. Luna Sales is a $300 billion asset manager. We manage roughly $30 billion in dedicated securitized assets, and our Resi book is about $2.5 billion, focused on all portions of the capital structure. I got started in this business out of grad school in 2008, which was an interesting time. And I've been working in the buy side in various roles, focused on structured products, quantitative trading, and research.
Great, thanks. Really glad to be here with you guys because we've had many conversations in the past in different iterations as well, not just with you guys and other colleagues. Obviously, Steve, Alessandro, and I have dug into RMBS over the years in a lot of detail, and a lot of the issues that we've talked about will come into focus, I think, during this conversation. So let's get started now. Clearly, the thing that's on everyone's mind when it comes to PLS is the impact of COVID. And we'll be covering a number of topics today, but in the short time that we have. But from an investor perspective, and this can run the range, and we know each of these we could talk about for days. But for the two of you as investors, what are you looking at in terms of the impact of COVID, the different relief plans, changes to the relief plans, whether or not that creates new opportunities or risks, and how some of the changes then sort of changed the landscape that you were laboring to address, going forward. How are you thinking about it, both in terms within your own houses, from what you can say, not asking any proprietary information, but also as investors generally, and what investors should be thinking about at this moment? And then I'll discuss with you as well. And either one can kick off. Kishore, if you'd like.
Yeah, so the interesting thing about this crisis and the aftermath is that we as structured finance investors, particularly RMBS sector, has not been at the center of this crisis. And unlike the last one, which I lived through, so also the big difference is that even though this is not the epicenter of the crisis, other areas are more in the center of the crisis. We had quick relief to the homeowners and quick relief to the consumers from the government compared to the last time. I mean, last time there was a huge delay in providing any relief to the homeowners, and there was a lot of problems created as a result of that delay. So I think this cycle has been very interesting, because whatever distress was felt, especially in the QSIP space, was very short-lived, March through maybe May, and then after that everything is kind of tightened quite a bit by now, and maybe there is some gap widening in March, but it's nothing substantial. But I think compared to what CMBS has gone through, RMBS has come out like very well in this cycle, I'm pleased to note.
Yeah, I agree, Steve.
Yeah, I think Kishore hit the nail on the head with the idea that it's nice this time around not to be the epicenter of the current crisis. In fact, the nature of COVID has kind of brought forward a lot of the long-term fundamental tailwinds for U.S. housing, right? And if you think about us broadly, the citizens of the U.S. being relegated to our homes, people want to be in their houses. They want to remain in their homes, and it creates a strong demand for housing. So, in some sense, it's been a little bit of a positive in terms of securities. And what we experienced in March, certainly that was dramatic. And what we're realizing now with the various forbearance programs is that the government has a much heavier hand in the housing market and much more direction in terms of how things unfold. That said, this also does bring to fore some of the kind of long-standing issues we have in PLS in terms of disclosure and reporting and understanding what's truly unfolding in all of our loans, right? So, this is something that we kind of still have to work through and still are working through as an industry. But these various borrower assistance programs are really important for the consumer, and it's important that we as investors understand how they impact our bonds.
I could agree completely with everything that you both have just said, and I want to unpack it just a bit, starting with the following. There's no question that, imagine if we had faced a pandemic in 2008 with everything, all of the underlying infirmity in the sector and in the loans, and we hit that. It's a very, very different economy. It was funny, I remember, in 2019, going into 20, people would say, if and when the recession occurs, we were talking about what the impacts would be. Certainly from a PLS standpoint, one of the issues there was that, and again, pointing to the conversations that we've had over the course of the last, almost decade now about PLS and its efforts to come back and assume a more prominent place in the housing finance landscape. There are issues involved, but the impact of the sector has been muted. And so even if there were issues in PLS, it would not cause the kind of issues that it did in 2008. But looking at the numbers now and focusing on PLS in particular, but we can take it into agency and government as well. We know that roughly 25 to 30% is non-agency, and most of that is on balance sheet. And the thing that I always say about balance sheet is that's just, if you've got a loan on your books, you can give forbearance, not give forbearance. That's up to you. You're going to have to answer for that at some point in terms of what you do, but that's your willingness to forego a mortgage loan payment from a borrower for that month. But in PLS, it's different, and we look at the different metrics, and we know that One of the things and we talked about, and I'd like to talk about here, we see what the average forbearance numbers are and the average delinquency numbers. And people say, well, this week it was 5.76%. Next week it goes down to 5.74%. To me, the averages are somewhat misleading because we have very concentrated risk in different parts of the sector. So for example, expanded credit non-QM, we see forbearances and delinquencies look very different than in jumbo prime. In terms of the differences in the way that you're thinking about it, and again, I'll look at opportunities and risks in the different parts of the sector. How are you thinking about that? What are you seeing? And do you think are you trying to get more granular in your view of what those numbers, what's really underlying those numbers?
Yeah, I mean, I think that's what we have to do as investors, right? I think everyone certainly is working with a lot of uncertainty here in terms of what's appropriate to offer the borrower and when, how to determine whether or not an impairment is truly permanent, and how that's going to, really at the end of the day impact your cash flow. For us, it's been, the easiest thing to focus on is cash, right? Try and focus on cash coming into the structure, making sure that it's going where you'd expect given the numbers that you have access to and what's reported to you, and try and work with the various issuers and sponsors to try and understand how they're working through things. Obviously, everyone is negotiating with their corresponding servicers, the various parties that deals to try and get things reported as they can. But you have to, as a bond investor, be cognizant of the fact that machinery isn't always working properly. And at the end of the day, what you can really rely on is the cash you see and the cash that's coming to you.
Right. Kishore, thoughts on that? I'll hold my follow-up questions in a moment.
Yeah, I think it's important to know the pools and the makeup of the pools that you're involved in, because given that in many of these, the subordination levels are still quite substantially low. I mean, compared to the 2007 vintage, they're probably higher, but not substantially higher. Maybe they started out at 2x in the beginning of this cycle, but I think they're slowly grinding tighter from that level. So yeah, in CRT particularly, I think there is a very important need to look at what's out there in the pools because of the very thin subordination levels in CRT. Mm-hmm. And in non-agencies, the more seasoned securitizations, there is a whole substantial amount of subordination, and they have their own issues. So it's not. It's not as important as in, let's say, prime jumbo and CRT to look at the pools in light of the COVID-19 because they're already delinquent borrowers in some of those pools. Mm-hmm. In the non-QM space, particularly in seasoned delinquent securitizations. Yeah, but I think the reporting is still, I should say, not uniform, if I'm not mistaken. I think that's something investors are definitely concerned about, what is being reported versus what is being done for the loans to make them pay and make them not default. It's not, I don't think it's still clear to the investors.
Right. And I think, for those who are in the listening in, this is one of the things in the task force. Starting in the next few weeks, we're going to be bringing in different speakers to speak to that. And it goes to the part about what you just said, Steve, which is thinking about some of the issues around post-crisis PLS, many of which are stronger and addressed issues from pre-crisis PLS, but others that reflect still certain risks to investors. And in this case, and touching on what Kishore said, it's, for example, inconsistencies in reporting. You could have 2 or 3 different servicers in a deal. One of the things that we're seeing in the sector is differences in the way that delinquencies are reported, differences in the way that loss mitigation is reported. And it may or may not be, and my 2 fellows at the Milken Institute and I, Ted Tozer and Mike Stegman and I, wrote a paper back in May of last year anticipating this on PLS and forbearance and other loss mitigation and what to look out for. Not that I'd like to say I was looking at a crystal ball, but it seemed very clear to us what these risks would be, and I think they're playing out. So if you have different servicers who are reporting all those metrics differently, it's sort of, I've said it, it sort of obliterates the accuracy and usefulness of the reports because you don't know what you're looking at. You don't know if those numbers are accurate and what the risks are, not only to you, but just to the cash flows, even in some cases to ratings. And it's not just now, it's not just what's happening to the cash flows now, but it's what's going to go forward as we come out of COVID. Because to me, it's one thing to have the relief in hand now, but it's another to see coming out of it. To me, not all forbearances and delinquencies are created equal. And the story of who's going to resume their ability to sustain mortgage debt, or who's going to get a sustainable repayment plan or deferral or modification, and what those impacts are on the cash flows, that's going to make all the difference in the world to participants in this sector now. And clearly, it's not just new origination, it's other loans too, right? In the RPL space, even in the single family rental space as well, to the extent, depends on who owns the properties and whether or not rents are coming in. So, from that standpoint, do you think in terms of what you've been seeing, and I want to touch on breaches in a little bit as well, does it concern you? And what about, have you had conversations with rating agencies or other investors in terms of, or other participants, even servicers, in terms of the differences, whether or not your questions are being answered, whether or not, the story that you're getting puts you in a place where you think that you have what you need to make an informed investment or portfolio management decision with respect to these deals?
I can speak for our experience, at least, with respect to the rating agencies, the conversations I had fairly early on in the pandemic about their approach and how they were thinking about stressing deals was as reasonable as it could be. I think we have to be honest with ourselves about the amount of uncertainty we're facing as an industry, and there's no real kind of silver bullet to what's going to be the perfect answer for the appropriate amount of stress, right? We're all waiting to see if these kind of consumer allowances can coincide with the reopening of the economy, and that a lot of borrowers can pick themselves up at the same time that these programs expire. I don't know that there's really a right way to approach that. I think in terms of trying to understand how transactions are evolving and what folks are doing, you really have to get on the phone with the sponsors that are parties to the deals you're invested in, try and understand what their approach is, and then have them walk you through where that shows up in a remit. That's the best way that you're going to get a sense for what's happening in a deal. And oftentimes, there are honest answers about a lack of ability to disclose or a way to unify reporting that are a product of the environment we exist in. It doesn't seem to me, at least, that there's a tangible way to change that in the immediate term. But the best you can do is try to work with, and it really is kind of on a sponsor by sponsor, deal by deal basis to try and understand that, unfortunately. But that's the only way that you can try and get some clarity about what's going on and assess that risk. But again, the reality is there's quite a bit of uncertainty, and you have to make an educated decision about, an investment decision about whether or not you think you're being compensated for that uncertainty. Quite a few places in the market, I would argue, you aren't currently. So we'll see how that, we're kind of still in the thick of it, obviously, right? We have to see how that unfolds to see if levels currently justify what's going to unfold over the near term.
Right.
I mean, there have been some changes by agencies in their methodology in the wake of the storm, but I think there has not been any, at least what I could see in terms of, standardizing reporting. I think there were some initiatives earlier in the past after the financial crisis to address some of these issues. I think I can't remember whether it was ASF or someone else who was trying to come up with a standardized reporting on mods in particular, but I haven't seen any follow through on that. At least maybe I missed something, but I haven't seen anything that has been carried forward in that department.
I think, there's two things there. What the ASF put out their standard reporting package. So in the disclosure package, which was basically the mortgage loan schedule being sold into the deal, then the disclosure package, the reporting package, which was the ongoing servicer reporting. And it was in there. And then we tried to address standardization with an RMBS 3.0, right, as part of SFIG. And I had chaired that for the 5 years that we had the initiative. And that wasn't to enforce standardization, but at least point out the differences. How do you ask what those differences are? Adam, Steve, as you were talking about before, understand what's in that deal, right? Understand how the servicer is servicing, who makes the decisions around loss mitigation, who makes the decision around breach reviews, right? Decision around breach review we'll get to in a moment as well, because it really goes to what's in that deal, who holds the discretion to make decisions, whether or not that can conflict with other bondholders across the capital stack. There's a question that came in, I'll read off now, that there are other standards, there's more standardization out there in terms of MISMO, UMBS disclosure, for example. Could PLS adopt some of these? I finished a 2-year term as a MISMO board of director as well in December, I think was the end of that term. Amazing standardization work that they've done. One of the issues around that is that you could implement going forward more standardization across the industry if you had the will across the industry to pick it up, or if there was, if you had a self-regulatory organization that, such as ISDA does with swaps, or just more buy-in, or for example, if investors demanded it, because if investors demand it, then issuers will adopt it. As an issuer, and I've been an issuer, including post-crisis, one of the questions is, why should I implement this particular provision? What would expose me as the issuer to? What will be the benefit? And part of that is if investors will come, if they demand it, if rating agencies require it, that, that can help shape an industry, and, shape the deal standards. The thing here, and this is one of the things that we talked about in the paper, and that was called, I forgot the name of it, but forbearance and PLS standards, again, put it out in May of 2020 as part of the Milken Institute, was there's going to be a look back in terms of PLS and how it performed during the pandemic in the wake of the required forbearances and who makes it out, who doesn't, what the impact is on cash flows, whether or not there's sufficient oversight and enforcement to make sure that investors don't suffer what I've always called misallocated losses. We saw that pre-crisis. That was called a misallocated loss, a loss that an investor bore that was actually supposed to be borne by usually an issuer, mortgage loan originator, or a servicer. And without the proper oversight, without the proper enforcement, things can get passed through to investors and taken out of the cash flows that shouldn't be. And once again, on a systemic scale, it's not going to take down the housing finance system or the broader economy now because of the size of the market. But if you're holding a position, if you're holding 50 million in a particular deal, that's going to matter to you. Right? Whatever your portfolio is in the space, it's going to matter to you as an investor. So in terms of the answer around standardization, and Steve or Kishore, if you want to weigh in as well, it could be, there's always room for it. But one of the things we're going to have to look at now, I think, are twofold. One is, did all the participants in a particular transaction follow the rules of the governing documents? And in some cases, with their hands tied, even if they wanted, for example, to provide more forbearance, maybe they couldn't because of the terms of the pooling and servicing agreement, or because one bondholder who exercised that authority wasn't inclined to give that level of forbearance relief. And then two, overall, did you have the kind of servicing, oversight, and enforcement to ensure that the terms were complied with? But I don't know, thoughts from you guys if with respect to standardization going forward or even now.
So the issue of standardization is not just in terms of investors versus the issuer and servicer, but also within investors, there is, seniors, mezz class, and, junior bondholders. So the pre-crisis, the pre-financial crisis deals, they had such a complex structure that, what we noticed afterwards is that as classes were steadily getting eroded due to losses, we reached a point in some cases where all the subs got eroded, and we had seen strange things happening, like the seniors were not supposed to be paid sequential once they reach certain level of losses, etc. And yet servicers would typically sometimes not follow the rules because they also didn't see this happening before. Everybody has to understand that these are not normal things that happen, right? So we had to go to the servicers and ask them, hey, this is what we think should be, not what you did. So sometimes they ended up correcting these things. on the fly in the next month or so. But progressively, what happened is that servicers became very uncommunicative. Initially, they were receptive to talking to investors, but I think after a while, they became very uncommunicative, because of lawsuits and whatnot happening after a while. And I think this cycle is somewhat more easier, I think, because the structures are more cleaner, even though I think from issuer to issuer, the structures are different. I think the details are different from issuer to issuer, but still, I think there's less complexity compared to the previous cycle. But on the CRT side, I think there is enough complexity even now. I think if you look at their triggers and how those triggers impact the cash flows to the bondholders, you only have to look at CRTs. There were these deals with fixed loss severity, variable loss severity. Some deals are locked out. Some deals have, some other mechanisms. I think there are at least 4 or 5 different classifications within that CRT structure itself, even though they look similar, but they're not similar. So I think it may be easier this time around, given that that's the size is smaller in terms of the number of deals that are out there, and also the structures are somewhat less complex. But at the same time, investors have to be alert as to some of the things like whether the servicers are actually following the waterfall or not, and how you can check that. I mean, sometimes it may be hard for you to check as well, because how much information is being disclosed about forbearance and any losses related to some of these modifications? We don't know yet, right? I mean, we haven't seen much in terms of those actions. So it would be interesting to see once these forbearance plans run out in 3 months, 6 months, or whatever amount of time it will be, because I think we already got an extension to June, I think, right? For forbearance, at least
But for agency government, right? Yeah,
for
depending
agency,
on, it's very
right?
channel
For agents,
specific, right?
yeah. So I think we still haven't seen the full impact of all these actions. So because I'm sure some of these borrowers are still being reported as not delinquent in some cases, and some cases maybe they're reported as delinquent. I think, Eric, you wrote about this in your paper, I think, right?
Yeah, that's right. Yeah.
So that's a valid point. So I think the complexity is less so, but not for the investor in a particular deal. They still have to watch out for various issues related to how they're getting paid or not getting paid still.
I agree.
Yeah.
Great point. Steve, go ahead. Yeah, please.
I think we're definitely a beneficiary this time around of just the magnitude of the shock being a little less than 2008, right? So certainly you don't have structures breaking at a rate into the severity that they did the last time around. That said, as Kishore pointed out, right, you still have problems around disclosure and loss mit and how that's truly being flown through or put through the waterfall. And you're kind of in many cases too much in the dark to be able to make a determination about whether or not that's appropriate. I think we'll touch on breaches, you said, in a minute, so I'll leave that aside. But I would very much agree with your sentiment about the sector being evaluated in terms of our performance as it regards the consumer. I think that's going to be an important thing to bear in mind broadly, right? Have servicers in these deals been treating the consumer fairly, and fairly may really be through the lens of what's being offered to the broad government housing program. So if outcomes are particularly more severe in the PLS market, I think it's going to cast a pretty harsh light on our sector. So we have to, particularly as these things unwind and forbearance programs wind down, bear in mind that, the most economic outcome may not be the most beneficial for the sector if we're really going to be seen as a place where the consumer is done significantly more harm than they would have had in a government-backed loan.
So I absolutely, and that's a great segue, because I want to get into that, and it brings in breaches in the CFPB and the consumer and quality of loan originations and servicing. And I'll use this. We had another question that came in as a jumping off point. And the question is, do most investors sufficiently understand the risks of misallocated losses, and how do losses get misallocated? And once again, generally speaking, it's what are the things, if you had a perfect world where all loans were originated perfectly, every breach was, or if there was a breach, every breach was found, pursued, enforced properly, the applicable party who's supposed to cover the breaches, buy the loan out, indemnify the trust, if indemnification is there, if they paid their share so that investors only suffered normal credit risk losses, right? Loss of default, not because of a defective loan or defective servicing, but the losses that they know they're signing up for when they're buying a bond, right? When they're buying into a deal. If that's the case, you have perfectly allocated losses, misallocated losses. Every dollar that should have been borne by somebody else that's borne by an investor, that's a misallocated loss. So here, among the differences in deals, there, once again, there's differences in reporting, there's differences in transparency in terms of what the deals require, what the deals allowed, which parties are making the decisions. Kishore, you mentioned CRTs, and you know this actually ties in something. So Alessandro Pagani of Loomis, who is also chair of FIIN, I still believe is the chair. He was at an ABS East conference just a few years ago, pointed out that for CRT, and it's disclosed very, very plainly in the disclosure documents, the offering documents for the CRT deals, that Fannie and Freddie exercise discretion over breach reviews and other servicing decisions, and that they will act in the best interest of Fannie and Freddie in their own best interest, which could conflict with the interest of other bondholders. And that holds true for PLS too when it comes to controlling holders or servicing administrators. Other, you know, particularly could be the sponsor or affiliates of the sponsor who have the ability to make various levels of servicing decisions, all the way down to driving loss MIT in their capacity. If they have risk retention, they hold the sub pieces, and they can conflict with, and it sort of basically it entrenches or embeds tranche warfare into the documents. Right, so post-crisis, that's different than pre-crisis, where you had efforts of tranche warfare. Here, it actually embeds the discretion in some cases in the subholder. And Kishore, this goes to your point about different bondholders, different different objectives and different interests. But I want to swing this back to the question of servicing. Today, the CFPB just rescinded seven directives or guidances that were issued during the pandemic, during last year, I should say, that recognize the difficulty on servicers of dealing with the pandemic and dealing with all the pandemic required of them operationally. And it afforded them some flexibility with respect to compliance of certain servicing regulations and other laws. Those were rescinded today, saying, look, the consumer is paramount. Things are going more smoothly. We see a light at the end of the tunnel. And so that could pose a risk not just for servicers, but also for what happens in the deal. If there's things like assignee liability, if errors of the servicer, if those aren't caught and the consequences pass through to investors. So let's talk about that now, you know, sort of going forward, and then also the role of the CFPB and, you know, where certain, you know, risks in terms of what the Bureau is doing can impact investors. And again, I'll happy to weigh in after your thoughts as well.
So the major issue with the RMBS sector in the US is, and I have seen other countries RMBS as well as part of my responsibilities in the past, particularly UK, is that it's just too, shall I say, disjointed, because, you know, the origination, securitization, servicing, they're all separate functions and they're all performed by different parties. So basically investors are at the, shall I say, mercy of various parties. So they wrote a blank check when they buy these securities without any guarantees of performance. So that's a basic concern of mine in the during the last cycle. In fact, at one point I proposed that we should have something more closer to what UK does in UK RMBS, which is more like a master trust type of securitization, where the seller servicer has the, you know, big slice of the pool. so that their interests are aligned with the investors' interests. I mean, it's a very structural problem. The way I see it, that too many parties, we don't know who is responsible for the investor at the end of the day. So this is a classic theoretical case of agency problem. You know, the manager is not responsible for the investor. You know, the manager of the pools are not responsible for the investor. Whereas in CMBS, which I traded as well, it's somewhat different. You know, the bottom, you know, the servicer typically owns the bottommost classes, and they, at least we know that they manage the pool to their benefit. At least everybody knows that, you know. So there is a clear identification of who benefits from the actions of the servicer there. You know, the BP is buyer and the servicer are commonly the same, you know. So that's why I think there are structural issues in this sector, and the more I spend my time in this sector, and it's been a long time now, the more I feel like it's kind of like baked into the system, you know, that you have no clear responsibility for the investor in any of these securitizations. So at least that's my view. You know.
Steve?
Yeah, I think, I mean, I would maybe touch on the embedded tranche warfare and the nature of the structural problems the industry made an attempt at solving, or deals are now making an attempt at solving, with the directing note holder and breach reviews and triggers have kind of created an interesting circumstance now where you can have transactions where those triggers are going to or are tripping, and you're at a point where you may have a large chunk of loans that are most likely, again, disclosure isn't always there, but most likely in some forbearance program, but nevertheless are going to cause a large chunk of breach reviews. And that's a cost that the structure is going to have to absorb. But is that, you know, truly what the trigger was intended for? Do we, as investors, want that expense to be incurred? And it's created an interesting dichotomy between the way the problems the structure was ostensibly set up to solve, and, you know, presented with this, you know, a brand new crisis with kind of different drivers and different outcomes that kind of jerks it in another direction. And we do kind of seem to be always working to chase our tails a little bit and find the right solution for a new problem that's coming up, and watching it filter through these transactions.
Right. Well, I'll tell you, there are two things. We're coming up to 3:40, and like I said, it's short, compressed time, but very happy to engage on these questions. There's so much more that we could talk about or could have talked about today. But for anyone in the audience, two things. One, feel free to engage through the Fixed Income Investor Network on any of these questions and other things that are in mind. The second thing is, I know that I think Adam Granger is on listening in from FIIN. Maybe Adam, if you could send my paper around, because Steve, and we talked about this, we talked about the issue of breach reviews. Are breach reviews being done for loans that are in forbearance, and should they be done, right? Is there discretion in that? Is it a cost that's put through to investors? Is it a cost, right? It's not what they were really intended for. Breach reviews were there in order, just before loans were going to go to foreclosure, in order to make sure that, hey, if there's a breach, let's buy them out. And maybe if something can be done about the breach, we'll do it now, not after the loan's been foreclosed on and, the property sold at REO. And so there's so much to it, but happy to talk about that more as well. And, happy to engage separately and apart from the task force, but anyone who's on would like to join the task force, would love to have you on there. It really is just more about trying to arm investors more with better information, better tools to protect themselves and to make more informed risk decisions and financial decisions around their portfolio investments and future acquisitions. So let me stop there and say thank you to Kishore and Steve. Any last thoughts on this before we wind up in the next minute on the landscape going forward? Do you think that we'll come out of it strongly, that the metrics will continue to point towards health, or do you see some blips around the corner?
Yeah, I think we are in a much stronger position this time around, as I said earlier. I think because the housing market is doing very well, and so any of these issues that we're seeing in terms of these forbearance and other issues will go away because of the strong housing market, and also the economy recovering as the pandemic recedes. Those are two positives in my view. So that should keep the sector in good health this time.
Great. And Steve?
Yeah, we seem to have some great tailwinds at our back, and the market seems to be in good stead. It is nonetheless, I think, going to be an interesting year as we watch all these forbearance programs expire and the economy reopen. We'll see if that presents opportunities or challenges.
I agree. I see it as sort of a tale of two cities, where hopefully most folks will be fine to come out of this, and we can direct aid to the people who haven't, because, again, to both your points, it's the mortgage industry didn't create this. Borrowers didn't bring this on themselves. And so the more we can direct aid where it's needed, I think the less it will cost, the more effective that aid will be. And ultimately, and Steve, back to your point about the way that PLS looks in all of this, did it bring the aid to the housing finance system and to consumers, or were there deficiencies? Was it too rigid? Was there too much conflict of interest? That's going to be measured, that's going to be evaluated. And I do think that anything that's a negative check mark against PLS will have an outsized influence on its reputation. And we saw what happened in the crisis. I think we've been very different, even with all our challenges going forward. And hopefully that won't be the case, because I think all of us believe that PLS can be a much more meaningful and safe part of the housing finance system and landscape. It's just a question of making sure that nothing happens to derail that, and it can come back safely. So I think we're aligned on that too. Anyway, thank you both for being here. Adam, Granger, thank you very much for setting this up. Audience, thank you for listening in, and feel free to reach out if you have any questions on any of these topics or others. And apart from that, have a great day. Thank you.
Thank you.
Thank you,
everybody. I can share your paper around, Eric, with all the attendees.
Sounds great. I hope it's helpful and happy to discuss. Thanks very much.
Thanks, everybody.
Thank you.